Right, let's make a start. Anyone logging on after this will just miss my intro. So welcome everybody to the year-end tax planning get ahead for 2024-2025. My name's Esther. I'm a partner at Kingston Smith, and I should be doing some very light chairing this morning. There's quite a lot of familiar delegates on the list. So most of you probably do know who we are, but for those of you who don't know who we are, Kingston Smith is a top 10 audit, tax and advisory firm. We work with businesses, entrepreneurial businesses across all different sectors, as well as not-for-profit and private clients. And we have lots of other specialist departments such as M&A, advisory, and a legal team, and of course IFA advisors and personal tax advisors as well, who we'll hear from today. So in this webinar, our experts are going to be explaining which tax allowances are changing, as well as providing guidance on how to proactively prepare for the new tax year. So I'm delighted to be joined by David Mitchell, who is Director and Chartered Financial Planner at Kingston Smith Financial Advisors.
Good morning.
And David specialises in advising entrepreneurs, company executives and investors on their retirement planning, investment and protection needs. And David's very sort of holistic approach enables him to tailor financial solutions that reflect each client's priorities and aspirations. Welcome also Joseph Adunse. He's one of our tax directors, and Joseph has many, many years experience of advising a range of private clients on issues that affect them, particularly on income tax, capital gains tax and inheritance tax. And Joseph also has significant expertise in advising private clients who've got international aspects to their tax affairs. So welcome both of you. And I shall be asking David and Joseph a few questions. So please do, let's make this interactive. This webinar is for you. In order for you to get as much out of this as possible, please do ask questions and I will weave those in. Please do put them in the Q&A function. Much easier to keep track of them there. Any unanswered questions at the end, we can get back to you with answers on those. The session is being recorded, so please do share it with your peers or anyone else who is unable to attend today. And there will be a little bit of feedback form at the end, which would be lovely if you could fill out, because it's super helpful in helping us shape future webinars. So let's start. So Joseph, I think we're kicking off with you with a little sort of, give us a little overview on sort of what rates and allowances are changing from the 6th of April 2024.
Yeah, so thanks, Esther. So there's just a little table here, just with a load of numbers, just so you can keep track of what I'm saying. So the first rate that's sort of going to be changing from the 6th of April is the dividend allowance, which you might remember halved from £2,000 at the beginning of this tax year. But it's going to be halving again from £1,000 to £500. Just a reminder, sort of the dividend allowance is sort of the level of dividends which are taxed at 0% rate. And the next sort of thing that will be changing is sort of the capital gains tax annual exempt amount. Again, that was about £12,000 prior to the beginning of this tax year, and halved to £6,000. And then from the sort of 6th of April, that's also halving again to £3,000. And the sort of annual exempt amount is basically the first portion of capital gains you can realise without sort of having to pay any capital gains tax in the tax year. So the next thing that's changing is national insurance contributions. You might remember from the autumn statement, this was one of the announcements that the Chancellor made. So for employees, that's already changed from the 6th of January in terms of a reduction from 12% for the sort of main rates to 10%. And for sort of, reasons I can explain later, but the ones for self-employed people as well as people in partnerships is only reducing from the 6th of April, and that's going from 9% down to 8%. So effectively, it's just for the first sort of 12,000 to 50,000 of sort of profits that you pay that rate of national insurance if you're self-employed. The other kind of national insurance which self-employed people have to pay is called Class 2. So that's the sort of bit that actually gives you entitlement to sort of benefits and things like the state pension if you're self-employed. It's a reasonably small amount, but that is completely going from the 6th of April. So that's effectively intended to simplify sort of how self-employed people are taxed, and B, also to give them a sort of saving. I know it's called national insurance, but I think most people consider it a tax. So it's effectively an additional tax saving for people who are self-employed. There will still be an option for people to pay that voluntarily. And the reason why you might want to do that is because if you have sort of self-employment profits below around £6,500, you won't get any sort of, qualifying years towards your state pension and stuff like that. So you would have to pay the national insurance and maintain that. So you have a qualifying year. And for people who don't know, you need about 30 years now to get sort of entitlement to the full state pension. There are some other changes to sort of tax bands, but that only affects people who live in Scotland. So I'm not sure how many people on the webinar would be Scottish taxpayers, but Scotland has more tax bands than England and Wales, and there's going to be more divergence from the 6th of April. So I won't go too much into that, but just to make you aware, if you are somebody who lives in Scotland, you've probably heard about it anyway, but it's just something else that's going to be changing. Yes, sir.
So yeah, I mean, there's a lot of detail there on that slide, and I'm sure that we can share that with people afterwards if they haven't had a chance to, to digest it. So, I mean, what can we do? What can we do to mitigate the effect of these changing rates and allowances? Because there's a lot going on, isn't there? And it seems to continually change. This is the thing.
Yes, it does. So for the dividend allowance, if you somebody that sort of has their own company, this could be a company that you trade and provide services through. If you haven't already considered sort of what dividends you might want to sort of pay before the end of the tax year, you could pay a dividend to take advantage of slightly higher dividend allowance. There are sort of like formalities that have to be gone through to declare a valid dividend, and you do have to have sufficient distributable reserves in the company from which a dividend can be paid. So you just have to make sure those sort of procedures are followed, and then if everything's looking okay, then you can make sure that you pay a dividend before the end of the tax year, just to take advantage of that higher dividend allowance. For capital gains tax, if you've got an investment advisor, you might want to talk to them about, what your portfolio is looking like. Is there any possibility of realizing any capital gains to make use of the higher annual exempt amounts? If you have any investments that are sitting at losses, you might want to think about when you actually crystallize those losses. For example, if you have say 5,000 of gain and then you have 10,000 of losses, what you don't want to do is sort of realize those losses necessarily now, because they're automatically offset against the gain, but that gain might anyway be covered by the annual exempt amount. So you might want to defer the loss realization to the next tax year, where you would have less of an annual exempt amount against which gains can be set. So that's just something you want to just consider now. It might feel like a bit complicated, but your financial advisor, I'm sure, can help you, as well as your tax advisor. They can work with your financial advisor as well. Always have to do that for clients generally.
Joseph, do we still have the bed and breakfasting rules?
Yeah, we do. Yeah, so these are particular rules. So they're designed to stop people effectively, or I'll say being too clever, by sort of, doing sorts of things I've said. So there's limitations in the sense that if you buy shares, if you own shares currently in a company, and you decide to sell them, perhaps to sort of realize capital gain, and then you intend to sort of buy them back shortly afterwards, you do have to wait sort of a specific period of time, so that you actually achieve the tax planning outcome you intend. It's the number to have in mind is sort of 30 days.
Yeah.
So 30 days after you've sold the shares, then you're free to sort of buy them back. If you want to, without the sort of bed and breakfast and rules applying. They effectively dictate the order that sort of things are matched, which are not necessarily how you might have expected them to be matched. So it's just a way to make sure you're not caught by those rules effectively. And then for national insurance, I mean, that one's a little bit more difficult if you're self-employed, but you could, if you're able to defer sort of work that you're doing. I mean, the saving isn't as significant, I suppose, so you might think that it's not worthwhile, but for people on the margin it might be. So you might decide to sort of defer sort of the provision of services if that's what your self-employment is, or your sale of goods if you can, until the following tax year, so that you have sort of slightly less national insurance at the main rate to pay.
Sorry, somebody's asked what the bed and breakfast rules are. It's basically where you sell shares. Say you've got, I don't know, BT shares, you sell them on the 5th of April to realise your capital gain that you've currently got in them, hopefully get that at 0%, and then you buy them back again the next day. So it's to stop people being clever with utilization of the rate. So like Joseph talked about, you've got to leave this 30-day window before you bought the same shares back again, i.e. there's got to be a level of risk there if you're going to do that, because obviously in that 30 days the shares could go massively up or down, who knows. So you can't just sort of sell and buy back to realize gains at a zero rate.
If I can just very briefly jump in there as well, Esther.
Yeah.
The bed and breakfasting rules are for an individual. So for excuse me, for a couple, either married couple or for civil partners, one of the couple could sell the shares and the other of the couple could buy them. There's also a bed and ISA rule, so you can sell shares and then buy them back through an ISA, which are ways of manipulating the bed and breakfasting rules to your advantage.
Yeah, clever. So there's ways around these things. We've got good advisors, you see. So Joseph, just continuing with you for a little bit then. So what about married couples? Well, yeah, from David's point, really, married couples and people in civil partnerships, what sort of clever things are available for them?
Yeah, so there are some tax advantages to being married. I'm sure there's other advantages as well. So if you have sort of one spouse or civil partner that currently might own all the investments of the married couple, you might consider whether or not it's appropriate to sort of split those, amongst yourselves. Typically, sort of splitting assets between married couples are kind of neutral events for tax purposes. So you might want to sort of vary the split of ownership of the assets, just so that you have two lots of the exemptions that would otherwise apply to just one person. So that could be a way to kind of effectively, improve your combined tax position. If you currently already own sort of assets jointly, but they're sort of split 50-50, you might want to think about varying the ownership. There are sort of ways that you can kind of move an asset from being 50-50 to, say, 99%, 1%. That's perfectly acceptable. If it's an asset from which you derive income, that tends to be sort of something that is quite popular. If there's a sort of a spouse or civil partner who's not working, for example, rather than sort of completely leave their sort of allowances unused, you might want to take advantage of that and make sure you're using it. If you are going to do that, though, there are again some formalities, in the sense that you have to submit a particular form to HMRC for that to work. So just watch that. Again, your tax advisor will be able to advise you on that to make sure you're not sort of only half doing what you ought to do, and finding out later on you haven't done all the right things and don't get the advantage you hope to. So just to be aware that if you are going to go down that route, that's something you have to do in terms of an admin process. But yeah, that's definitely a good sort of idea for people in rental property, for example. That tends to be quite a common one. And then Yeah, there's the same points for capital gains without an exempt amount. Making sure that you're taking advantage of having double the exempt amount, really, by ensuring the assets are held as efficiently as possible amongst you as a married couple.
And what about employees? What sort of allowances and reliefs might they be able to utilise before the end of the tax year?
Yeah, so I guess the main one is for people who have high marginal rates of tax. I mean, the headline top rate of income tax is 45%, but you might have heard, particularly over the last few months, a lot more about people who have higher marginal income rates of tax. These are people who sort of claim child benefit. So you might be aware that if you earn more than 50,000 and you claim child benefit, that begins to be clawed back effectively until you earn over 60,000 and completely goes. So that band of income between 50 and 60, because when you take into account the clawing back of the child benefit, your effective rate of tax, it is effectively a tax because it comes out through your self-assessment, it goes up to 60%. So again, similar points can be considered if you're able to control what level of income you earn, if you're self-employed, for example, just to make sure you're coming down to below that 50,000 limit. You could also do things like pension contributions, which David will talk a little bit more about later. So then you're actually not reducing your earnings, but you're increasing, your future income if your pension does well, or you're certainly getting more tax relief on that as well. So, that's certainly something to be considering, looking at what your expected income is going to be at this point in the year, because you would hopefully have good visibility over that at this point, and making sure you're not being caught by that. And a similar point arises if you're sort of somebody who earns over 100,000 a year. There's a similar sort of high marginal rate of tax there of at least 60% between 100,000 and 125,000. So again, similar points about whether you can sort of reduce your income below that, or make pension contributions and similar things like that. So it's just thinking about that at this stage, while you've still got some time, would be a good idea. Yeah.
Thank you very much. Again, please do ask questions, everybody, and put them in the Q&A function, and I'll weave them in. David, so I think coming over to you then, what type of investment benefit from tax relief? There's lots of different sorts of investments, aren't there? And I think a lot of them people might not necessarily be familiar with.
Sure. Well, I mean, so the good news is there are a range of tax breaks and tax efficient wrappers that investors can take advantage of. So Joe just mentioned pensions, and I think we'll probably revisit those in a minute. Individual savings accounts, investment bonds, business relief schemes, investment funds such as open-ended investment companies, unit trusts, enterprise investment schemes, venture capital trusts. I may have forgotten a few, but we'll be sharing a 3-page summary after this, which has details of all the different sort of exemptions and stuff available, and some planning ideas. So do feel free to reach out to me and my colleagues as well, or put questions in the Q&A. With pensions, there's many different times. I know they're quite it can be quite confusing, but effectively think of them as the Swiss Army knife of financial planning. You get income or corporation tax relief depending on whether you're making a personal contribution or whether it's through your company. Tax-free appreciation, tax breaks on extraction when you take the money out at the other end, and IHT exemption. So lots of valuable benefits there. Individual savings accounts, or ISAs as they're probably better known. These are grown up and come in a range of different flavors now. But again, you get sort of tax advantages in the form of no tax on capital gains, no tax on income generated or extracted. There's tax relief on some types of ISA. So the lifetime ISA, you get a tax benefit by investing from the government. And you can invest in shares that are exempt from inheritance tax via an ISA. Investment bonds, which are not to be confused with government bonds or gilts or corporate bonds. They're a type of, they're a bit like a super ISA, really. I mean, they're written under life insurance rules, so they get a tax exemption. You get tax deferred appreciation, tax breaks on extraction, very handy for sort of planning income for higher earners. And it may be used with trusts when estate planning to mitigate inheritance tax. Then there's sort of the alphabetic spaghetti of EIS, VCT, or enterprise investment schemes and venture capital trusts. These are sort of effectively private equity type investments, and you get income tax relief for personal investment, tax-free growth. Venture capital trusts pay tax-free dividends. Enterprise investment schemes also benefit from an IHT exemption and a business relief exemption, and can provide capital gains tax deferral. If you've made a capital gain, you can defer the point at which you have to pay that by investing via an EIS. Then there's inheritance tax schemes, business relief exemption, applies to qualifying privately owned or AIM-listed trading companies. You can build a portfolio of qualifying investments and reduce your estate's inheritance tax whilst still retaining full access to the capital during your lifetime. And finally, investment funds, OICs, open-ended investment companies and unit trusts, what Americans call mutual funds. These offer some tax breaks, as within the investment fund itself, capital gains are exempt from tax, so they're a useful vehicle for holding your unwrapped investments, or anything that isn't in an ISA or a pension or a bond. If you hold it through an OIC or a unit trust, you can get the exemption, and it's possible to have a private OIC or unit trust if you've got sufficient capital to invest.
Quite a choice of different tax planning opportunities there, aren't there? And I think they've all got their own individual quirks and very different levels of tax relief and different sort of risk profiles as well. So I think anything there, you really are well advised to come to somebody like David and get some advice on what is appropriate for you. I mean, pensions, I suppose that's perhaps one of the ones, but pensions and ISAs maybe are probably the two that people are most familiar with. So just thinking about pensions first, I mean, you know, why are they so valuable in the financial planning jigsaw? Because people really should be thinking about pensions, shouldn't they?
Well, I think when you list out the benefits, I mean, they're a fantastic, solution, but I know there's lots of marketing people, and unless they're loyal clients are in marketing. I mean, if anything needed a rebrand, it would probably be pensions, because but believe me, it's not what people want to talk about. But when you start listing out the ways in which they can be used in your planning, and the incredibly generous benefits that are still available through pension investment, or investing via a pension, or using your pension as a vehicle, they're second to none. So when I'm working with my clients, we use them for saving for the future, reducing tax bills, passing on wealth, either immediately through by pensions for children and grandchildren, or ultimately, if you're in a position where you're not going to necessarily spend all of your pension money, you can use it to pass on to the next generation, exempt from inheritance tax. And actually exempt from tax if you die before 75. The cap that used to be in place, the lifetime allowance, has been lifted by the government. The rules on exactly what that means are now sort of like they're now established. Excuse me, and will kick in from 24-25. The annual allowance that you can pay into a pension has increased now to £60,000. Depending on your income, it gets tapered if you're a higher earner, but it gets tapered
quite massively, doesn't it, David?
Yeah, well, so the 60,000, actually you can go back 3 tax years as well. So if you're in some circumstances, you could pay up to £180,000 and get tax relief in the current tax year. And next year, that will increase to £200,000, obviously depending on whether you've made contributions and various other things. Within the pension wrapper itself, effectively it's a tax exempt, tax exempt structure. So you don't pay capital gains when you make them within the pension. You don't pay income on income received within the pension itself. You pay tax when it's paid out to you, but not as it accumulates. And you can hold pretty much, most investments outside of residential property. So cash deposits, now that we're getting rewarded for holding cash again, you can benefit from all the tax relief on the way in, tax relief on the extraction, and take no investment risk by holding an interest-bearing cash deposit. A lot of our clients are looking at using their pensions to hold property. You can hold your company premises within pensions, and you can pool that across different sort of shareholders within the business, or family members.
Somebody's asked about
yeah.
What sort of properties can you hold in a pension? Can you hold any property in a pension?
Right. Okay. So the answer is not residential. So if you're thinking about your house in the pension, no, you can't. If you have a hotel, you can put that in, but not a bed and breakfast. You can buy through a sort of flexible self-invested pension. You can buy off plan, but as soon as you get building consent, it becomes residential. So it's effectively designed for commercial property, so offices, shops, warehouses. And I think the most common application I've seen, in my sort of planning career, has been businesses buying their premises, and then the company pays the rent into their pension. So it's another way of kind of building up a store of wealth for for the future, which is not using their pension contribution allowances.
Thank you.
So just to go into a couple of more quick points, unless there's any other questions. Sorry, Esther.
No.
So inheritance tax. So pensions are exempt from inheritance tax. It's entirely outside of the estate, and you can open pensions for grandchildren. So a very sort of useful sort of planning tool for passing on that wealth to the next generation. And if you're as I said previously, in a privileged position of having multiple sources of income when you do either retire or stop working purely for a living, then your pension assets can pass on to the next generation without inheritance tax. And if you die before 75, it's entirely free from income tax, up to the lifetime and protected lifetime allowances. There are some caps in place, but they're also so complicated you're probably better off taking individual advice. And one final thing, which Joseph did mention, child benefit, which if you make pension contributions, it extends your basic rate band. So making a personal pension contribution will reduce effectively your income. So it might bring you back into the point where you're able to claim full child benefit without paying the tax on it. Or if your income's above 100,000, you'll reclaim your personal allowance and therefore reduce the income tax that you pay, which gives you a sort of 60% tax saving in that. That's sort of like a bit between 100 and 125,000 pounds, where there's a marginal rate of tax, effectively 60%. So all in all, if I didn't call them pensions, I think a lot of people would be biting my arm off to hear more about them.
We have a couple of questions. So somebody's asked, would there be a capital gains tax on the transfer of business premises into the pension?
Yeah, any disposal of a property would attract capital gains, so will be assessed for capital gains tax.
And somebody else picking up on the comment about the abolition of the lifetime allowance. So now that it's been scrapped, do any of the existing protections retain any effectiveness should an incoming government choose to cap them again?
Right. Okay. Interesting. So if a future government were to change the rules, then potentially, I was going to say, but I mean, historically, when governments have done, they haven't sort of like gone out to punish people that have, you know, taken valid planning decisions. I think if there's a, you know, very obvious abuse, you know, as we sort of saw with the withdrawal of, like, you know, I know, was it side relief, which all the film schemes and stuff like that. I mean, that relief was never really intended for the purpose for which planners were using it, so. The answer is that the current government have been very clear that if you have a form of protection and you make pension contributions, you will no longer lose that form of protection. So the protection will give you a higher rate of tax-free cash extraction. That will not be impacted. So you can, if you're subject to one of the forms of protection, you can now make personal pension contributions, and that's now you know, been confirmed by HMRC.
Thank you. So moving on to maybe ISAs then, again, one of the other ones that people are perhaps a bit more familiar with. I mean, the Chancellor's referred to the simplification of the ISA rules. Are they simple though?
Yeah, far from it, Esther. I mean, there are now 6 types of ISA, all of which with different rules applying. So I think the Chancellor and I probably disagree on what simplification means. But, so I mean, so cash ISAs, you know, stocks and shares ISAs, junior ISAs, lifetime ISAs, innovative finance ISAs, help to buy ISAs. Those have been replaced, but you can still invest into one of those if you have one. I think the main thing to bear in mind is that there's a £20,000 allowance. So each of us is entitled to invest up to £20,000, and you can invest in different types of ISA. In the current tax year, you can only invest in one of each type of ISA. The simplification that Mr. Hunt brought in was that from next tax year, you'll be able to invest in more than one of the same type of ISA. So massively simplifying everything for everybody. The lifetime ISA is restricted to 4,000, the junior ISA to 9,000. There is an interesting planning opportunity for those of you who are comfortable making very substantial gifts to young adults in your family, in that from the age of 16 up, a young person can invest not only there, or you can invest into a junior ISA for the young person, but the young person is also allowed to open their own ISA. They have a £20,000 allowance. So effectively that gives a £29,000 allowance between the ages of 16 and 18, depending on whether tax years fall for your young adult. There's a substantial planning opportunity to pass on some wealth if you feel comfortable with them having complete control of such a large amount of money at such a young age. And the rules aren't changing really from 23, 24. Those allowances have been pretty much in place for a while. The junior ISA allowance went up a couple of years ago. But aside from the ability to invest in multiple ISAs, there's not really a change from 24, 25 onwards. There is potentially some innovation that might be coming down the track. Potentially, and again, I say potentially, this is certainly something that's been in discussion you know, at higher levels, is how to get more people investing into UK. And there has been some talk about a British ISA or a UK ISA, which, you know, potentially would be further incentivized to you know, to invest into UK companies, so either a higher allowance or, you know, potentially inheritance tax exemption. But as I say, this is probably speculation, but certainly sort of something that, you know, that I would like to see from a planning point of view. So that we do need to invest into the UK. I think that would you know, certainly encourage further investment.
Mm-hmm. And what else? I mean, what other efficient planning investments are there?
I kind of mentioned them before, but enterprise investment schemes and venture capital trusts, well, these are, you know, incentivizing people to invest into the UK. So they were initially launched in the 90s to incentivize investment into small UK companies. So either unlisted or AIM listed or privately owned companies. The tax breaks are pretty generous. I sort of mentioned them sort of briefly, but 30% income tax relief, and it's income tax, so it's not available for companies. So it's purely for personal investment, capital gains tax-free growth. So if you invest and you hold them for the qualifying period, which is 3 years for enterprise investment schemes and 5 years for venture capital trust, and you make a profit, then the profit is exempt from capital gains tax. Venture capital trusts provide tax-free dividends. So again, it's a really useful, provided you have sufficiently diversified portfolio and a fairly robust attitude to investment risk. It's a way of sort of generating a future sort of tax-free income for yourself by taking the dividends. And some of the venture capital trusts have been running for many years and are kicking out a sort of 5% tax exempt dividend. So fairly attractive for someone with a diversified portfolio. Enterprise investment schemes typically won't pay any kind of dividend. They're more about growth, and you can get a capital gains tax deferral by investing, and will fall under the business relief exemption for inheritance tax. So they're exempt from inheritance tax once you've owned them for 2 years. And if you are exiting a business, for example, that was that followed the business relief, you can use the sort of rollover relief to reinvest into either EIS or other business relief exempt investments, and therefore preserve that sort of exemption from inheritance tax. So certainly anyone thinking of exiting a trading company, potentially if one of their concerns is passing on the wealth to the future generations, either EIS or business relief exempt investments might be a good way of part of or building that into some of the planning. We must mention the risk there before we sort of move on from that, which is in terms of where I prioritise planning for people. So I think pensions and ISAs absolutely where you should start. The EIS and VCTs, they have the fantastic tax breaks, but they also come with that a very sort of substantial risk. As we know, sort of smaller companies are more prone to to either not growing in the way that they hoped, or worse, ending up sort of like folding. So it would be sort of sensible to only have a relatively modest amount of your total wealth exposed to EIS or VCTs, and I'm talking, I guess, in that sort of 5 to 10% of your investable wealth, provided you've already used up your other exempt allowances into pensions, ISAs, and maybe sort of put some other provision in place to provide you with an income in the future.
Yeah, and just to say on the risk, the government are aware of the riskiness of EIS and SEIS. So in the unfortunate event that the company does go bust, you can get income tax relief on the loss that you realise as well. So that to some extent mitigates your loss overall.
No, that's a really good point. In fact, you can get income tax relief as well as capital gains tax exemption on an EIS investment that goes bust, as well as the CGT deferral. So the tax mitigation is very, very important, and I think does de-risk the investment. But as always, we sort of say, don't let the tax tail wag the investment dog. This has to be an investment you feel comfortable making. And you don't want to make it just to get the tax breaks. But having said that, you are very much incentivized by the tax reliefs and tax mitigation to hold those kind of investments portfolio.
Super. And a question around sort of buy-to-let sort of activity, in that they're saying obviously lots of the tax reliefs around that have been sort of chipped away over the years. In your view, can it still work as a tax efficient investment proposition? It's a big question, isn't it? But maybe just
it is a big question. I would say, Esther, isn't that as an Esther question rather than a David?
I'm always asking about that.
I mean, I'm a massive fan of diversification. You know, so the tools in my toolbox, you know, the ones that we've talked about. You know, when it comes down to, you know, property investment, you know, I would always defer to property experts, but a lot of my clients have, you know, buy-to-let investments as well as, you know, other investments. Having been a private landlord myself, you know, it is a, you know, it is a lot more hands-on than a lot of, you know, these kind of like, you know, other investment products. So, you know, I would encourage anyone that either is considering it or has a buy-to-let portfolio to bear in mind the, you know, the enormous time cost that comes with it, as well as the other sort of, you know, tax, you know, advantages, disadvantages, etc. I think the government is really sort of driving, I mean, the trajectory of subsequent governments has been more towards wanting larger, you know, larger property portfolios rather than lots and lots of, you know, individual landlords. I think it's harder to regulate, you know, and you know, the tax breaks have been kind of, you know, withdrawn over time to make it less attractive for individuals and probably more attractive for either professional, you know, property investors or companies.
Super, thank you. And the only other questions we've got going are ones that we're just sort of answering offline because they're quite detailed. So I don't have any more questions from the audience, and we're literally 3 minutes off the end time, and I'm sure everybody would be delighted to get 3 minutes back into their diaries. So I think we'll call that a close. Thank you very much, everyone, for attending this morning. The webinar was recorded, so it will be sent round. So please do share it with people who weren't able to make today's session. Our next webinar is going to focus on what a change in government could bring, also a very big question. So hopefully we'll see you all back for that. And please do complete the feedback form as well that we will share with you after this. So thank you very much and enjoy the rest of your day, everybody. Thank you.
Thank you.
Thank you.